Welcome to the Wealth for 99 podcast, episode 3. My name is Drew Rice, and each week I go over different personal finance, economic policy, and career-related topics for the average working class American, and with the goal of spreading awareness about how to better ourselves financially and to, make better financial futures in our current society. I'm going to be focusing on several topics, 5 specifically, and those are going to be the Trump versus Biden tax plan, understanding ETFs, so a big broad picture of what they are, why they exist, and how to pick one if you're interested in investing in them. Inverse and leverage ETFs, what they are, explaining some of the nomenclature, things like that. The stock market and gambling and how they connect. And then I'm going to be talking about simplifying portfolios for retirement planning, specifically a 3-fund portfolio. So I'm going to get started, and in between each topic, I will be checking the live chat and answering any questions or addressing any comments during that time. So if you have anything that comes up, put it in there and I will get to it. And in just a minute, I will get started on the first topic. Okay, so for the first topic today, I'm going to be going over the Trump versus Biden tax plan. My initial disclaimer that I want to put on this is that we don't have all the information as these plans are not fully fleshed out. And we also need to keep in mind that these plans are not, set in stone because Congress has the power of the purse, the president does not. And generally speaking, presidential budgets and tax policies are a little bit more than than political and economic theater. It usually doesn't end up exactly the way that they want it, so keep that in mind and take that with a grain of salt as I go over this. Also, I'm going to be doing this mostly as a comparison with Donald Trump's current tax plan because Trump is currently the president, and I'm going to be talking more about what the changes that Biden is planning on implementing. I will be touching on a couple topics that Trump has talked about implementing going forward as well, though, and I'll be doing a compare and contrast throughout the remainder of this topic. So first of all, I want to focus again on the average American and how these policies are going to affect them. So I want to start off by pointing out that I'm going to be looking from the perspective of the average American, which the median for the average American net worth is $50,000, and the median household income, that's household, not individual income, is about $60,000 per year. And I'll show you guys some stuff real quick to give you a better picture of what I'm talking about. Awesome. Cool. Now, when we're looking at this, we want to see that the median, and this is according to the census, and then Business Insider are the two sources that I'm looking at right now. But when we're looking at the median income, we can see that, as late as 2018, it was around $60,000 per year. So that's going to be important to keep in mind throughout the rest of this so that we understand when we're talking about different tax brackets, what percentage of the American population that's actually affecting. Also, I want to point out that it's going to vary widely by state because states obviously have very different cost of livings and very different average pays. And there's a map here. And this basically shows, this is a really good article that I'll have linked, and it basically shows you the breakdown of where I got that information. So that way you have an idea and can follow along if you wish. Also, I wanted to show this map just so we have a decent idea of how this is going to affect different states, relatively speaking to their general political preferences. So as we know, from looking at the Trump electoral map from 2016, we know that most of the center of the country was red, especially the South, with mostly the West and East coasts being blue. I think this is something that's really important to remember because as we look here on this chart, we can see that the median household income is the lowest in these white states, and the lighter the state, the lower the median household income. So that's going to mean that any of these tax policies that are going to benefit lower income Americans are going to disproportionately benefit those in the lighter colored and generally speaking red states. So let's keep that in mind going forward. As for the plan, we're going to start off talking about each individual tax, and I'm going to go over explaining what they are, what they're actually looking at, and how they affect you. So let's start with Biden's plan, and the first thing is income tax. So it was claimed on the last night of the RNC, the Republican National Convention, by Trump that Biden would raise taxes on almost all American families. And it was also claimed during the RNC by Eric Trump that 82% of Americans would see their taxes go up significantly under Biden's plan. Now, currently, the top marginal tax bracket in the United States is at $518,400. And then everything above that is taxed at a 37% rate. Biden hasn't mentioned anything about changing the brackets below the top income bracket. What he stated is that he will not increase the taxes on anyone making more than $400,000, which is less than 2% of Americans. And he also presumably, right, because essentially when you look at Biden's plan, what he's stated, the specifics he's given are that he wants to move the top tax income tax bracket up to 39.6% from the 37% that it currently is. And given that that is the percentage that Obama taxed in the top income bracket, and that Obama had the top income bracket set at 400,000 for individuals and 450 for joint filers, I have to assume that that is what he's following whenever he says the specific of not making 400,000 or more. Anyone other than that pay more in taxes. So I'm going to assume going forward that Biden's specific plan is 39.6% for the top income bracket, and that's going to start at 400,000 per year, which basically means that he wants the income tax to be the way it was under Obama. He wants to revert back to what it was before the 2017 tax cuts. Now, to understand where this fits in historically, I think it's really important to look and see how tax rates have changed over time. And this is going to be according to the Tax Policy Center. And again, all the links will be in the bio below. And basically, when we are looking at income rates and the highest marginal income rates. So if anyone doesn't know how marginal income tax works, basically there are certain brackets, and up until you meet each of those thresholds, then you are taxed at a different percentage. So as an example, if the marginal income tax doesn't start until $30,000, then for the first $30,000, you would pay no income tax. If it's then, 10% or 20% or whatever the percentage is after that, then you will be taxed at that percentage from that point until the next bracket, which then every dollar after that will be taxed at the higher percentage. So when he says he's going to raise the top income tax bracket, unless you're making above that threshold, that is not going to affect your income tax. So I want to make sure that's really clear. And I also want to make sure that when we're looking at this chart, that we're understanding that this is very simplified, and this is just looking at what the percentage is on the top tax bracket. It is not keeping in mind things like changes in itemization, i.e. lowering your taxable income, what those limits were that year. It doesn't consider what the price was, like what the salary was in that top income bracket. And that's something just to keep in mind, and understand that when we're looking at this, this is not all the information, because you aren't going to be able to put all of that in one chart. But basically, when we look, we can see historically that U.S. tax rates, like on income, peaked in about the 1950s and early 1960s right here. And that was in the 90%. And so when we're thinking about taxation, I think it's really important for us to have a historical perspective and understand that, when we say taxes are low or high, we need to be very historically aware of what that means in context, and understand that we've had historically very low taxes since, essentially the second Reagan term. And you can see that really clearly on here. Reagan came into office in 1980. Taxes were at 70%. By the end of his first term, he had already cut them down about 50%. Like he had cut them 50% down to, a 50% rate. And then by the end of his second term, he had cut that in half again. So really big drops during the Reagan administration. And since then, we haven't gotten above 40% again, despite being far higher than that throughout most of the modern U.S. tax history. So important to understand when we're going forward. As we're looking at this, that really puts in perspective that there's nothing really radical about Biden's plan. Whether you have preconceived notions, which we all do, there's nothing radical about it. It's, like I said, it's just removing the 2017 tax cuts, and that's important to understand. Also, again, if you're under 400K as an individual or under 450 filing jointly, then there should be no increase in your income tax directly. So now let's move on to the next set of taxes. So the next set of taxes is payroll taxes. So payroll taxes, when you look on if you're a normal W-2 employee, if you look on your pay stub, you will see a section that is SSDI, Social Security Disability Insurance. And this section that is taken auto-deducted from your pay, that is your payroll tax, and that is used to fund Social Security. Currently, it's 12.4%, and that's cut in half, with 6.2% coming from the employee's paycheck and 6.2% coming from the employer before the employee ever sees it. And I talked about in the last podcast about Trump wanting to remove the payroll tax for the next 6 months, and about the implications with that. So be sure to check that out if you want a understanding of what his full policy ideas are around the payroll tax. But currently, like I said, it's 6.2% for employee, 6.2% for the employer, and that's capped at $137,000 earned per year. So, and this increases with inflation annually. So the idea is that up until $137,000, you will pay that 6.2% on every dollar earned. But then once you get past $137,000, you pay no more taxes in the form of payroll taxes to Social Security. So high earners are generally, they're not paying any taxes towards the Social Security Disability Insurance beyond that point. And Biden's proposal on this is that he wants to start taxing the payroll tax again at $400,000, and because of the fact that the threshold currently at $137 increases with inflation annually, then over time that $137 would continue to increase so that it would meet the $400,000. And what this would do from a long-term standpoint is get it so that everyone in the United States, regardless of income, is putting something into Social Security. And that way we have, it for the future. And it's really important. Again, I mentioned this in the last time I talked about the Trump payroll tax. I think it's really important to understand how, big of a deal Social Security is, because as millennials, I think we've all kind of reserved ourselves that we shouldn't count on it, but we need to keep in mind that currently about 60% of people that are age 70 plus rely on over 50% of their income from Social Security. And that will be linked below, but that's according to the Social Security Administration. And also, it's really important that as millennials, we are way behind them. They're relying on it at this time. And as far as our net worth, we are way lagging behind the baby boomers and the Gen Xers. So most likely, we will end up needing to rely more on this type of income when we get to retirement age, assuming that it is going to still be around. So I think that's something that we all need to understand when we go and vote, and how that's going to affect us long term, because that is something that most of us don't think about when we're under 30. The next set of taxes are investment taxes. So this is probably this and estate taxes are the next three basically are the big differences for the Biden versus Trump tax plan. So investment taxes. So currently the top rate on long-term capital gains and qualified dividend income is 20%. Now, what this essentially means, so long-term capital gains are if you have an asset and it appreciates in value over time, and then you sell that asset for a gain, then you would pay long-term capital gains if that asset has been held for over a year. If it has not been, then you would pay short-term capital gains on it, which is at a higher tax rate. Currently, our tax rates in the United States for long-term capital gains are 0, 15, and 20% for depending on your tax bracket for long-term capital gains. However, for short-term capital gains, they are taxed at whatever your highest income bracket is. This is really important because, as an example I talked about in my Dave Portnoy video, someone who makes that much money is being taxed currently at the highest bracket of 37%. And so if he's buying stocks in a day trading or a swing trading fashion where he's selling them short term, the taxes he's paying are basically double, 37% instead of 20%. And that's why the more money that you make in our current tax system, you're going to lose a lot of money in taxes by doing short-term trades. And that's why you see a lot of people that are very well off really like dividend income because of the lower tax burden if it's a qualified dividend. And that's important to understand as well because not all dividends are taxed the same way. And so you need to be very scrupulous and make sure you understand whatever dividend investments you are making. But this is why you have situations like in 2012 when Mitt Romney was running for president, talking about how low of a tax rate that he paid. And also Warren Buffett, famously saying that he pays less taxes than his secretary. That's because the difference in the taxes on earned income for the average American and the taxes on capital gains for the investor class. And that's something that Biden is trying to change with his tax proposal. So what Biden wants to do is he wants to make it so that exception for long-term capital gains pretty much goes away. He wants, not for everyone though, and that's the key thing to remember here, is he wants it so that your long-term capital gains and qualified dividends are still taxed at the top income bracket that you have. But he wants to do that only for people that are making investment income of over $1 million per year. So back to what does the average American have when we're looking at median net worth? The median net worth of someone in the United States is $50,000. People making over $1 million a year, that is an infinitesimally small group of people that this is going to affect. That being said, this is definitely a big deal as far as donors are concerned because the people that are going to be affected are going to be the people that are donating to these campaigns. And so this is a really big difference for the rich investor class and may end up having some, backlash when it comes to, the stock market. It may have a little bit of an adjustment period because you're going to have less speculation most likely if people are going to be punished with those, increased taxation on trades. And that's something to keep in mind. The next one we're going to focus on is estate taxes. So here again, an estate tax is a tax on the monetary value of whatever it is you inherit when, you inherit an estate from a loved one or parent. And currently the estate tax is a flat 40% tax, and it only starts after the first 11.58 million per individual and 23.16 million per couple. So what this means is that if you have $11.57 million in assets when you die and you pass that on to your child, they will not pay, any estate tax in that. So the first 11.58, not an issue. After that, what he wants to do is instead of taxing it at a 40% level, what he wants to do is tax it at a graduated, or he hasn't said this specifically, but this is what Obama did, and it's pretty much the same plan, is he wants to start taxing it, graduatedly, so progressively from 40% to 77%. And that way it's, it's helping get more money from the people that are benefiting the most, holding these assets. Now, the bigger thing that he wants to do is remove the stepped up tax basis. And this is a really cool thing that Meet Kevin is a really good YouTuber that talks about this, but the stepped up tax basis is essentially a rule where if, say, I buy a property, and it's also important to remember that, again, this is within the estate tax, so it has to meet the threshold of 11.58 million. So say that I had $20 million worth of property, then what would happen is that the first 11,000 wouldn't even touch anyway, or 11 million wouldn't even touch anyway. Then the next, let's make it 21 for ease of math. So the next 10 million would be subject to that tax. However, if I were to say I bought that at, something obscene, like 5 million, right? Let's say I bought it at 5 million. If I had bought that at $5 million, if I were to sell that property before I died for the $20 million, I would then pay long-term capital gains tax, presumably that I'd held it, long enough for that. I would pay long-term capital gains tax on that entire growth of that $15 million. And instead, what the stepped-up tax basis allows is when I die, if I don't sell it and I just, let my kids inherit that, then they would only pay the tax for the capital gains tax on when that item is sold. So if they inherit it at 20 million, even though I paid 5 million for it, and they sell it at, say, 25 million, then they will get taxed on only that last 5 million. The rest will be non-taxed gained net worth that they have. And that's a really big loophole that is currently in our tax system for especially real estate moguls. And that's why Kevin talks about it a lot. So check out his video if you want a more thorough explanation of it, but that's essentially what it is. Biden wants to remove that. And the idea behind that is that, we don't need people to be hoarding so much money in the United States. That's his viewpoint, because it isn't helping anyone. Once you get past that 11.5 or that 23.16 million threshold, you're pretty set for life at that point, and it doesn't seem, like it's going to hurt them too much. Also, I think it's really important to understand and recognize that the average American dies with no money. So this is not, again, affecting the average person by any stretch of the imagination. We have the inverse problem in the United States currently. And there will be a good link below from a study that was conducted by MIT going over how big of a situation this is. And as I hinted to earlier, Biden hasn't made specific claims about changing the percentage or the starting bracket for the estate tax. But in 2009, when Obama, was in office, the estate tax started at 3.5 million as opposed to the 11.58 million threshold today, and it was graduated progressive tax from 40 to 77%. So based on the other details of Biden's plan and the commonality, it would suggest that he probably is going to also want to push for lowering that threshold, or at least putting in a progressive taxation above the current threshold. Hard to say. And also there has been some statements from the IRS that they probably will not approve lowering the threshold for the estate tax. So most likely it would be a progressive tax, but that is my assumption. He has not stated that explicitly yet. As for the next set of taxes, we have corporate taxes. So this, of course, is going to affect anyone that is incorporated, or a actual corporation. Not if you're individual, this will not affect you, at least not directly. Basically, the corporate taxes are currently at 21%, and Biden wants to increase that to 28%. Now, prior to the 2017 tax cuts, I know that there's been a lot of hyperbole around how, Biden is super left and, wants to raise so much taxes. It's important to keep in mind that he wants to move it 7 points to 28%, when prior to the 2017 tax cuts, it was 35%. So he's not even, he's only getting halfway back to what it was before. So again, this is not anything obscene or, it's not an outlier at all. It's it's actually it's a pretty Republican tax plan, like historically speaking. Now he also though wants to double the minimum tax on foreign profits to 10.5% on multinational corporations. So the idea here is that, you tax these corporations that are taking advantage of cheaper labor outside of the United States by putting a increased tax on them. Now, will this make a difference? I mean, yes, it'll make a difference in as far as the revenue in the United States for this specific tax will be double what it currently is. However, if I'm paying someone, 1/5 or even half the price, when you include their wages plus the supply chain costs, if I'm paying that, in a lesser economically advantaged country, then that's not really going to deter me from doing that because it's only 10.5% difference. So it's probably it's a step in the right direction in my opinion. However, it's not, I don't think it's going to move the needle as much as people think outside of just increasing overall tax revenue. Another corporate tax that he is implementing, or a specific, rule, if you will. So this is something that other people have coined as the Amazon rule. And so this is that Biden wants to put a 15% minimum tax on book profits, which he's, referring to net annual income for companies with over 100 million in income. So again, this would only start after the first 100 million in income has already occurred. So this, for the most part, will not be affecting any, one that considers themselves a small business, unless it's the Lakers applying for a PPE loan. But, it's clearly targeted at companies like Amazon that will run very low profits or no profits or even loss to avoid taxation and take advantage of the current tax code as it stands. And that's the goal of that and why it has that name. As for healthcare, so Trump has stated that he wants to cut the funding for Medicare and Medicaid, while Biden wants, to move Medicare eligibility from 65 to 60. So move it 5 years earlier. Now, another important thing to understand historically is that when Hillary, for example, was running in 2016, she wanted to move this all the way back to 55. So again, Biden's not going even as far as Hillary when it comes to expansion of Medicare and Medicaid. He's only meeting halfway between Trump and Hillary. So again, pretty, surprising, not anything outside of the realm of imagination. And Trump also wants to repeal the Affordable Care Act, which is commonly referred to as Obamacare. And I think it's really important to understand that, 20 million Americans gained health insurance from this. This would be a very big blow to a lot of lower income Americans. And we'll see. Trump and the Republicans have said that they're going to make a plan. They did whenever he was running in 2016. But there has not been any, anything that has passed or been proposed seriously. So, I'm not going to hold my breath. That being said, Biden nor Trump support Medicare for all, which, 69% of Americans want, according to polling. Check that in the description as well. But, the point here is that no matter what any talking head tells you, neither of their plans are anywhere close to being socialist or, outside of the realm of normalcy. I definitely think there's a big issue with cutting Medicare and Medicaid, because again, a lot of elderly and disabled and, just Americans that are that need that help are relying on that. That seems to be something that we should probably keep around, but you should definitely read into that and, formulate your own opinions. As for the other tax credits that Biden wants to, so this is actually a pretty cool part and this is stuff that I was not as aware of as I should have been. They're pretty cool. So first one is that he wants to, so first of all, a tax credit, if you aren't aware, is say I make, and again, I'm just going to do this for easy math. Let's say I make, $30,000 per year, and the threshold for taxation is 20,000. Then if I'm able to claim different things on my tax form, different tax credits to get that 10,000 tax credit, then what will happen is that will move my taxable income down from 30,000 to 20,000, which means that I would not pay taxes for anything above that 20,000 threshold, depending on which tax we're talking about. That's a general breakdown. You can look more in detail if you would like. As far as the specific tax credits that Biden is talking about reforming or implementing, he wants to implement a $5,000 tax credit for what he calls informal caregivers, which are loved ones and family members that are providing long-term elderly care. He wants to increase the child tax credit from $2,000 to $3,000 for children aged 6 to 17 and to $3,600 for 6 and under children during the remainder of the COVID crisis. That being said, as far as the definition of what he's going to call the line of demarcation of the end of the COVID crisis, I have not heard specifically, so take that with a grain of salt. He also wants to increase the child and dependent care credit up to $8,000 per child, with a grand total of $16,000 that you can use as a tax credit. And then he wants to increase the tax credits to $5,000 for the first year and to $2,500 for the second year. If a employer hires a person with disabilities and uses those, and then is able to use those funds for different, associated expenses. The ones that he specifically called out were education, housing, transportation, and also he is, in addition to that, suggesting that we provide 30,000 tax credit to businesses that improve access for disabled Americans. So those are both, pretty big suggestions. He also wants to reinstitute the full electric vehicle tax credit. So if you buy, an electric vehicle, a fully electric vehicle, in the past, it was $7,500 for the federal tax credit, and then it varied based on state. Same thing with a step-down scale as far as the cycles that product had been out, that gradually scales out. So essentially, he wants to move this back to what it was under Obama. So if you're someone that's interested in getting an electric vehicle or hydrogen fuel cell or any of those alternative vehicles, then this is something that you'd definitely be interested and could benefit from. And then he stated that he would support a carbon tax, but I haven't heard any specifics on that. So, take that for what it's worth. Then he also wants to put a $15,000 refundable tax credit for first-time home buyers. And the main change that he wants to make on this, because I believe this is what's already available, what he wants to change is that currently the tax credit is available in the following year's tax return. However, he wants to put it so that it's available at the time of purchase. So this would help lower income people or people that are, stretching to buy their first home, have a little bit more liquidity available to them within that first 12 months. So that would be the idea behind that. And then on top of that, this is a really pretty cool thing, especially for people like me that are renters. He wants to enact a new renter's credit to reduce rental and utility costs to 30% of income for low-income earners, as well as expanding the credit for building and or rehabbing affordable low-income housing. And as far as the threshold for what he is referring to as low income, I do not know specifically. However, I think that this is something that could be very good for the, average person that's trying to rent, especially in areas like Los Angeles, where I live, where rents are very often making up more than 30% of a person's income, especially if they are, making below six figures, which most people are. And then the other things that he has mentioned are he's mentioned some like not specific, but some different changes for retirement plans for small businesses, trying to find ways to fund, better subsidize those from the government so that, smaller businesses as opposed to just big corporations have better access to providing 401ks and good retirement plans for their employees. And he's also talked about changing around the taxation for individual 401ks under a certain threshold, so that people have a little bit more flexibility to move stuff around as far as like investment allocation, and being able to maybe pull them out if they need to during a time like right now with forgiveness. However, again, I have not seen the specifics on that. The information I'm getting is from Kiplinger, and that is linked below, so definitely check that out. Now, that's a lot to think about, especially if you're someone that's not a nerd about tax policy like I am. And here's the main takeaway. So the main thing we want to keep in mind is that, and this is my opinion, is that Biden's plan is not perfect or who I wanted. But when you look at it, it definitely favors the average American as far as the changes that it's making through the tax credits and the increased revenue through the increases of taxation on the top 2% of individuals and corporations. I think that that's good for the average American. And now there is something to consider here, that while your taxes will not directly be increased if you are in the bottom 98% of people, there will most likely be some associated increases in the cost of consumer goods and services. There will be a link down below showing that from the Tax Foundation. I think it's important to understand that when you're looking to pressure test an idea, I like to look at someone who has every reason to disagree with my point of view and see how good their best argument is. And the Tax Foundation, which is generally a right-leaning, organization, what their estimations are that this plan would increase the cost of consumer goods and services at about 1.5%. So, in my opinion, that's pretty small. And also it would increase a good amount of revenue and help to chip away at the growing deficit that we have been, rapidly expanding over the last, since the early 2000s, especially. It really sped up, during that time period and recently. Again, the other main thing to keep in mind is if you make less than $450,000 jointly, and are leaving less than $11.6 million to your kids, and you don't make $1 million or more in investment income, then you only have to gain from these proposals. So as far as other policies, that's up in the air. That's dependent on your personal perspectives, and what you value. But from a tax perspective, we can definitely see that the claims of this being outlandish or going to increase taxes for the average person just doesn't hold up to scrutiny. And so that's my opinion on the Biden tax policy and the proposed changes that he has compared to our current policy under Trump. And that is the end of this topic. Okay, and now I'm going to look at the live chat and catch up with what's been going on there. Okay. Hey, Elliot May. Thank you for tuning in. John Bork, why'd you delete your message? I know you. Elliot May. Thanks, man. This is interesting. I appreciate that. I agree. And then whose tax plan is more beneficial to millennials and younger, short-term and long-term? Can you present an argument one way or the other? I feel like I did. I feel like I did at this point. I assume that was beforehand. But yeah, in my personal opinion, I think that given the average, when you're looking at the state of millennials' incomes, net worths, and financial, sustainability long term, I think that it seems very evident that we're going to need to be planning for the future because we will probably need the help. And that's why it's important to educate ourselves financially and make sure that we understand the implications of what is being proposed by people that are far older than we are, because most of our The average, I believe I looked it up yesterday, the average congressman in the United States is 58 years old, and the two people running for president are both in their 70s. So I think it's very important for young people to get involved in politics as early as possible, or at least in understanding politics, because we need to know what is, who's looking out for us and who isn't, and make sure that we are supporting, our futures. And in my opinion, I think that this is good. These tax proposals seem to be a step in the right direction. Not that I agree with them 100%, but a step in the right direction. And thank you, Drew Rice 2024. I won't quite be old enough, but soon enough. not for running for this one, but thank you. I appreciate that. And as I said before, if you have any questions about any of the topics that I'm covering or anything under the sun, be sure to put that in the live chat, and I will get to that at the end of each topic. And in a moment, I will get started on the next topic, which is going to be understanding ETFs. I'm going to be going over the basic background of what ETFs are, why you should care about them, and yeah, so get ready. And this is a really long topic, this last one, because it's a lot of nuance. So most of these are 20 minutes, but yeah, that was like double. So thank you for your patience. Okay, so the next topic I want to cover is on ETFs. So this is going to be just a basic breakdown of what ETFs are and how you can better understand them as a young retail investor, and what are the different pitfalls, pros and cons. So to start off, ETF stands for Exchange Traded Fund. So the best way I can describe an ETF is that it's basically a mixture of a mutual/index fund and an individual stock. So basically, if you don't understand what that means, a individual stock is really cool because it is a backing of an individual security, i.e. a share in a company, commodity, or other type of security that anyone can buy with a generally low threshold to entry, i.e. you can download Robinhood or Webull or any of these mobile investing apps, and you can, with very little effort, without having to pay commission fees on those specific brokerages and on many brokerages today, you can buy a stock. And usually it's going to be a pretty low price relative to what mutual funds or index funds will cost that are not ETFs. So what a ETF is, what it seeks to do essentially is to get the diversification of a mutual fund or a index fund, i.e. lower the risk relative to an individual stock, but be more accessible to the average investor. And more specifically, it's a collection of securities, which are stocks, commodities, or bonds, generally speaking. And it's good for being able to have exposure in more stocks with less commission fees. So if you do use a brokerage that has commission fees, then each time you invest, i.e. buy or sell a stock, then you would have to pay a fee. ETFs, what they allow is, say you want to have exposure into 10 different stocks instead of one, and that way you spread your risk a little bit more. Instead of having to pay 10 separate commission fees, you just pay one for that ETF, and you get exposure to all of the underlying stocks within it. They usually track a specific segment of the market, so there will be examples of ETFs that track gold, they track silver, they'll track automotive, they'll track electric vehicles, or any or the S&P index, so the S&P 500. They'll usually track a specific segment of the market, and that's what you're looking for is exposure in that area. And they're different from mutual funds because they're traded directly on a stock exchange, whereas mutual funds is through a broker. What happens is they take the money from a bunch of different investors, they pool that money, and then use that to then buy, shares or, interest in the underlying stocks. And that gives them a little bit more leverage power because they're moving a lot more money. As an example, if you look on a lot of stocks, they're going to be something that the average person can afford as far as a price tag. But if you look at a mutual fund, like in Fidelity, one of the ones that I have, that mutual fund is, $290,000. Like I don't have $290,000 invested in that, but I have access to it because of the arbitrage essentially of all of these different investors. So that's kind of the difference. So the pros of an ETF, they are more diverse. They have more diversification than individual stocks, which means they're generally less risky. Depends though. You got to look. And they can offer a higher upside than some index funds, at least in the short term. So it's important to understand that historically, you're most likely 98% of the time going to be better off just buying S&P index funds than almost anything else. But ETFs, like say you're following an ETF that is a heavy tech ETF. In the last couple of years, tech has heavily outperformed the S&P 500. So that would be an example of a market segment that you could, follow through an ETF that could possibly outperform the S&P 500 over a given time period. So that's one of the reasons. It's also a little bit more exciting than just buying index funds if you want to be more of an active investor, which I don't necessarily suggest, but that is something that, at least emotionally can help you maybe get more into investing. And then it can offer access to leverage without the need for or the risk associated with a margin account. So what margin is, so let's say I am a person coming to buy stocks, and let's say I have $1,000 in my account. Well, if I have $1,000 in my account, then let's say I want to buy a stock that's $100, like Apple's around $100 right now. Let's say I want to buy a stock that's $100. I could either buy 10 shares of Apple, or I could buy, 5 shares of Apple and then buy something else so I don't have all my eggs in one basket. Or what I could do is I could have a margin account where I am able to trade with more money than I have. I absolutely do not suggest this, and most people should never think about doing this, in my opinion. But basically, you would pay a fee in order to have access to this extra debt, essentially, and then be able to invest with that debt. And the reason you would do this is because if you are correct that stock or that security is going to go up, then you end up getting double or whatever the multiplier is, depending on the amount of margin that you have, extra gains. And leveraged ETFs are a way to, basically take advantage of this. However, since you are not individually trading with margin, it's actually the investment fund that owns the ETF, like the underlying investments of the ETF, then they are the ones taking on the margin risk. So it helps limit your downside risk, because an ETF is it's created by an investment fund and they own the underlying securities, i.e. stocks, commodities, bonds, whatever. And then you are buying that financial product from them. So there's going to be a little bit of a fee associated with that because they're performing a service so that you can, have access to those underlying securities. And it can offer, another pro is that it can offer creative ways to invest for new investors. Along with leveraged ETFs, there's also things called inverse ETFs. And these are for people that don't want the hassle or the risk of trying to short stocks. And I will go over leveraged and inverse ETFs in the next topic. So I'll do a deep dive on that. Another pro is that you can offer access to companies that may be prohibitively high in share price. A good example of this is ARK. So ARK has several different ETFs. It's one of the most popular investment firms. One of theirs, and one of the claim to fame that they have, is that Tesla is in almost all, if not all, of their main ETFs. And one of theirs is ARKQ, ARKQ. That ETF is about $55 per share. And within that ETF, you have access to Tesla and Google stock. So If you're someone who has less money to invest, you're probably not going to spend $1,000 on a share of Google or $400+ on a share of Tesla. It's much more accessible for you to be able to buy $55 shares of ARKQ and have some access to both, because some is better than nothing. And then the last pro that I have is that it can be less complicated than picking mutual funds, because with mutual funds, you have to do a lot of research of looking at the fees and the performance and what are the underlying securities. And you have to do some of that with ETFs. But the difference is that with ETFs, the fees are generally baked in, meaning that like if you're buying this on, say, Robinhood or most brokerage platforms, you won't even see a fee. That's also something to be aware of, but it makes it a little bit less complicated for the beginning investor, which can be a positive. As for the cons of ETFs, because of what I was just saying, they are often misunderstood by retail investors, and I'll go over some specific examples shortly. And often they can be hard to sell if the volume is low. So as an example, whenever you look on a stock trading platform, and I will pull up an example. So if we were to look at, say, Yahoo Finance, and let's look at, say, Tesla, right? So if we look at Tesla, we should be able to see average volume. So the average volume, 82 million, right? Okay. Now, if you don't have any perspective on what that, means as far as, is that a lot? Is that a little? Here's an example to show you perspective. We'll look at ARKQ. ARKQ contains Tesla within it, but ARKQ is an average volume of 2.1 million. 2.1 million versus 82 million. Volume is the amount of people that are selling and buying stocks, and given a trading period. And that's really important to understand, because if say a stock is plummeting or an ETF is plummeting and you want to get rid of it, if there's not enough volume of buyers to pick up those shares, then you may get stuck holding a stock while it falls downhill. And that's something that I've experienced before with ETFs, and it is not a fun time. So something to keep in mind. And you should always be looking at the volume that stocks are traded at, especially if it's more risky or short term, because it can bite you. And that's something you should always look at. And then let's look at an example of ARK so you can see how this works. And let's share this back with you. And let's look at actively funded, actively managed ETFs. And let's look at ARKQ, the one that I was talking about. So ARKQ is a good example. They look at autonomous and robotic ETF. So they're looking at companies that are investing in or are, doing business in those areas. And let's look down and let's see what they're holding. So these are their top 10 holdings inside of that ETF. So if you buy a share of ARKQ, then 10% of what you've invested is going to be in Tesla. And then you're going to have, 3.6 in JD, 3.5 in Alphabet, which is Google, and so on. And that is, the way that an ETF will look when you actually go and do some research. And we will come back to this later so that you guys have a little bit more of a explanation on what you should do, in my opinion, when you're looking for ETFs. Now, when we're looking at the other con that I'd see is that because of the hidden fees that are baked in and make it simpler, at least from the outset, it's important to look at these and make sure you understand what you're paying for, whether directly or indirectly, before making a decision. So let's look at some examples. I want to show you some examples of ETFs and mutual funds. So when it comes to Fidelity, that's who I use for my retirement investing. And I like to use, specifically, I use S&P 500 index fund. That's my primary thing that I go for. And that is FXIAX. And this is an S&P 500 index fund. And as an example, one of the most common ETFs that tracks the S&P 500 is SPY, SPY. So just so we have a general understanding, most of the time, mutual funds are more expensive than ETFs, and that's a positive for ETFs. However, index funds are usually less expensive than ETFs that track the same index. As an example, FXAIX that I was talking about that I use, it has an expense ratio of 0.015. Now, let's show, whereas, and I'm going to show you the calculator on this, whereas SPY, that ETF that tracks exactly the same thing, SPY has an expense ratio of 0.095. Now, why does this matter? This matters because when we're looking and we're trying to see how much this is going to cost us, I think it's really important to understand, and this is also linked below. Let's say, in an example, you're a pretty normal person, right? Let's say you only have $1,000, so we're even starting pretty small. And let's say your future annual contributions, let's say you don't even max out your Roth IRA. Let's say you just put in $5,000 per year. So about $100 per week that you're saving. And let's say that you are a pretty normal person. You haven't been able to save until paying off student debt or, whatever it may be, and you're starting at 30. So this is not an extreme example. This is a pretty normal example. And then let's say 8% per year, because that's the general return in the S&P 500 adjusting for inflation. And let's say, let's look at our two expense ratios. So we saw that SPY is 0.095, and I might have to log in. I do not. Great. And FXAIX, we can see the expense ratio here is 0.015. So I'm going to go here. This is my Fidelity. So we got 0.015. And fund number 2, this is going to be SPY. So for SPY again, it is 0.095. So when I put this in and I calculate, so over the course, of 30 years, so from the time of 30 to 60, then this is going to cost me about $8,500, and they are literally the same thing. Like the investment, the underlying investment is the same thing. There is no reason to pay that because you're not going to get anything different out of it. So understanding things like this is really important when you're making a decision on whether to buy an individual ETF versus a index fund. Make sure you are always looking that up and knowing what you're investing in. Now, coming back to the topic away from the screen, what I want to talk about is when we're looking at these, it's going to really depend, right? As an example, I point out that SPY is a rather expensive one, and I find that funny because a lot of day traders really like SPY. But if you're a normal investor that's going to be buying and holding, in my opinion, the better ETF for S&P 500 index fund is going to be VOO, VOO, and that's through Vanguard. Instead of having that 0.095 fee, it only has a 0.03 fee. So it's 1/3 the cost, and that's still double the Fidelity index fund. But if you're a person that doesn't have access to that through an employer, or you don't have a brokerage account set up and you're just getting started and you just have Robinhood or Webull, then VOO, in my opinion, is the best for the average person to go after. So definitely check that out if you're interested in buying index funds, which in my opinion everyone should be. Now, mutual funds are actively managed and indexes are generally, not. They follow an index and it's passive. So that's why mutual funds are going to be more expensive. And so the advantage, though, is that mutual funds, presumably a financial advisor who knows more than you is looking out for you, and they're actively managing it and moving your investments around. Most people, like historically, if you look at the different examples, they're proponents of each. Dave Ramsey likes mutual funds over index funds. Warren Buffett likes index funds for the average person. I tend to side with, Warren Buffett. He has much more of a track record. And generally speaking, index funds are going to outperform 98% of mutual funds. So in my opinion, the best thing is just to get index funds. And that's what I generally do when it comes to my retirement investing. But I will go over that shortly with more detail. Now, there are, generally speaking, 8 that you can break these down any way you want, but I have 8 different types of ETFs I want to go over. So the first are index ETFs. Index ETFs track an index like the NASDAQ or the S&P 500. Examples for these are, for the NASDAQ, QQQ, and for the S&P 500, as I mentioned before, are SPY or VOO. And let me share my screen because this is too many acronyms for you guys to remember. So we're following along here where we have the types of ETFs, and we have now second is industry ETFs. So industry ETFs follow a specific industry. The examples that I have here are the esports industry, which is nerd. They're usually very memorable like this. That's the goal, is because they want average people looking at them, and knowing, just like when you type in a search term, it makes it easier for you to come across them. And low carbon energy, smog, SMOG, and then, as I pointed out before, ARK-Q, which is autonomous tech and robotics. And ARK has a lot of different investment options, as I pointed out earlier, and I will go over some of those later. Bond ETFs. So bond ETFs essentially follow the bond market. The bond market is, generally speaking, used as a hedge against the stock market because they tend to do well in times when stocks are doing poorly. So this is something that a lot of people like to use to mitigate risk. They have ETFs for that as well. And I think that the Vanguard Total Bond Market, BND, is my personal favorite out of those. Commodity ETFs, you have gold. So, and as you can see, they're pretty memorable, like GLD, IAU, because AU, the symbol for gold, like the chemical symbol, and then silver, corn, ethanol. They even have soybean as a commodity. So a commodity is, generally speaking, something that is, has economic value, but does not produce economic value. It is, something that there is a limited supply of, and, it tries to track the demand curve of that. Currency ETFs. So this is a way where people that are not, at a point where they want to trade Forex, i.e. looking at the changes between different currencies, this is a way that they can still have access to the currency market. And examples are, the Japanese yen and the euro, and, every currency under the sun, there's pretty much an ETF for it. So that is a good way to dip your toe into understanding that market before trying to do something like Forex, which I do not do. Inverse ETFs. So inverse ETFs are ETFs that are used to simulate shorting a stock. These are, the prominent examples are SH, which is a 1X short of the S&P 500, and then DOG, because it's dogging on the Dow, which is a 1X short of the Dow. And then leveraged ETFs are the next one. Leveraged ETFs are those ETFs that allow you to basically, trade as though you have a margin account without some of the negative aspects. And those are, TQQQ, which is a 3X leverage of the NASDAQ. And then, Gold Miners Bull NUG-T, which is a 2X of a gold ETF. And then you can even have combinations, and there's way, way too many different types to mention, but these are the main types that, people should generally know about. And, a good example of this is, as I pointed out with TQQQ, you have, SQQQ, which T is the, triple leveraged, and then S is the negative triple leveraged. So this would be an example where if you think that it's going to go down, then you would buy the triple short if you were very confident, and then when it went down, you would gain 3 times as much. So that's the kind of the idea behind it. And they have this for, semiconductors. So that's why we have a semiconductor bear 3X. So this is an example where you have semiconductor, so it's on a specific segment of the market. It's an industry ETF combined with a inverse ETF because it's a bear ETF, and then combined with a leverage ETF because it has a 3X margin. So there's tons of ways that, there's tons of different basically products that these investment companies come out with for you to invest in as a young investor. And I think that's really important for new people to understand, because we should not be investing in things that we do not understand. Now, I want to point out that everything that I've mentioned here, other than the Fidelity S&P index funds that I use in my retirement account, I do not buy any of these or have an interest. So Yeah, this is nothing personal whatsoever. These are just examples. And overall, what I would say is that ETFs are great for new investors because they're going to help give you diversification without having to worry about making sure you're not getting hosed on actively managed fees. They're also a really great way to learn about stocks because, at least on a macro level, because you get better at viewing, if I'm looking at, say, semiconductor ETF, then I'm at least learning something about that macro trend in the market as a whole, as opposed to speculating on individual companies. And I think that's a better long-term way for someone to learn how to invest in the market and see trends both up and down. And, as I said, it's vital to know what you are investing in and to understand the product itself. And that's why it's really important that you read the stuff for ETFs. And as an example, I'll show you back on the ARC-Q, just so you have something to look at. So when we're reading ETFs, we want to always research them and understand what they, do, what they are. So when you look here, you have, the ticker symbol. If all you know is the ticker symbol, you should not be investing in it. Then what we want to know is, okay, what is the expense ratio? Okay, 0.75. That's pretty high. Remember, for the index fund, you're generally looking at 0.03. So this is a very high expense ratio. That being said, we want to look at, okay, how well is it performing? What's our, general, gains? Is that something that's going to be better than the index fund? If it is, then maybe you still want to pay for that. Also, again, if you want to have access to different stocks, you want to look at what are the stocks underlying it. If this is heavily invested in Tesla, and I think Tesla is not great, but I want access to, JD and Alphabet, then I probably don't want to invest in the ETF that's, going to be heavily influenced by Tesla, relatively speaking. And then you also want to look at what's the description, what does the fund do? We'll go over this more specifically in the next topic. And you want to, read about it. Make sure you understand it very well before investing in something, anything, ETFs and otherwise. And that's going to be the end of this topic. So I'm going to head back to the chat. Awesome. Brian Henry, thank you for coming by. Hey, Brian is a good friend who is, he's very much more into options trading than I am, and I've learned a thing or two from him as well. So appreciate that, Brian. Elliot, thank you so much. I appreciate that. And Adam Young, yeah. So you'll have to go. It was in the first 40 minutes. I believe I cut that off at about 39 and a half. But go through and hear it out. But basically just looking at it from the perspective of how it's going to affect the average American relative to the current tax plan. Thank you for stopping by. I appreciate that. Enjoyed having a good conversation with you a couple months ago about one of my videos. So thank you for joining us. And in a minute, I will get started on the next topic. Awesome. Okay, so the next topic I'm going to cover, and I will be checking the live chat for those of us that have just joined. I will be checking the live chat in between topics. So if you have a question, just be patient, and I will get to it once I finish the topic that I am on. I want to make sure I stay focused on this, live chat and cover all the information that I have planned for today. So thank you for your patience. I appreciate it. For the next topic, what I want to talk about is inverse and leveraged ETFs. So first of all, what are they? An inverse or a leveraged ETF is a way for investors to use leverage, which is debt, and or short investment vehicles in a much simpler way without having to have a margin account. The reason you wouldn't want to have a margin account, or at least some of the negatives for a margin account, are that it has higher fees for access to margin, and also can have increased risk because of the multiplicative factor of, when you are not winning with your investment. Margin accounts are when a broker allows an investor to trade with more money than they have, which is leverage or debt. And, they do this for an interest fee. And in my opinion, this is for most people a bad idea and not worth the cost because, the amount that debt increases the risk of losing most or all of an investment is too high for the average person. You're most likely better off not doing it. That being said, your mileage may vary. Now, shorting, which is what inverse ETFs are essentially, trying to, follow basically, give you an option to do so. So if you've seen The Big Short, then you have at least some idea of what this is. And in that movie, you'll remember that the people that were shorting were losing their pants, when they were wrong and the market continued going up and up and up. And this is a pretty big issue with shorting, is what's called short squeezing, where shorts have to pay oftentimes dividends or other penalties for, shorting something that they're wrong about. And this, along with, just having to have a much better understanding of investing than the average person, shorting is something that most people are not going to want to do. So what inverse ETFs do is they give you a way to, if you think that a security is going to decrease in value and you want to, bet on that, then you can do that by just buying an ETF. Whereas with a short, what you would have to do is you essentially place a bet by buying, shares of a stock for whatever the current price is. And then what happens is when it drops, you sell those shares back to that broker, and then you keep the difference in price. So if it goes down, let's say you buy $5,000 worth of stock. If it goes down to, $4,000, then you will have gained $1,000. And that's the idea behind it, in a very general sense. The problem you have is that, let's say you buy a stock, and let's say you short a stock that is, $100. If that stock's $100, you short it, and that stock goes up over 100% of the value of the stock, then you will lose all of your money. So it's the same issue. Is if you buy that same $5,000 worth of stock, if it goes up to $6,000, then you have lost that $1,000. So if it goes up 100% of its value or more, you can, in theory, lose more money than you put in, which most people should not and probably don't want to deal with that type of a risk. Whereas with an ETF that is shorting the market, the most you can lose is your initial investment. You can lose it at a much faster rate if it's leveraged and inverse, but you'll lose it. You'll only lose that 100%, not more. And that's another advantage of inverse ETFs. So leveraged ETFs, and a little bit more of a deep dive on those. So these are ETFs where the investment manager, so the fund company like ARK in our previous example, is using leverage. So they're the ones using the margin, can't believe it's not butter, to increase the amount that they can invest in that, those underlying securities. And the hope is that this is going to increase the rate of return. So these, like I said, they carry more risk because they can fall faster or increase faster. So good examples of this are QQQ and TQQQ. So QQQ, and I'll pull this up so you guys can see what's going on with me. So when we're looking as an example and we want to see, we're going to go to Yahoo Finance. And we have QQQ. All right. So when we're looking at QQQ, we want to see, let's look at TQQ next to it. Cool. I don't want an Audi, dude. Okay, dope. So as we can see here, we have TQQ and we have QQQ. Last trading day, QQQ, which tracks the NASDAQ. So these are mostly the tech companies, the bigger tech companies, that is. It went up 2.5% basically. And as you can see, TQQ went up 7.01%. So let's look, 2.32. 6.96, almost 7.01. This is essentially what TQQQ is supposed to do. It is a daily 3 times leveraged ETF. So essentially each day it is supposed to go up at about 3 times the rate of the underlying ETF, which is the NASDAQ index. This is really important to understand because when you look as an example, if you look at what they're supposed to do lifetime, they don't always match up, right? So let's look real quick and let's see the difference. We have lifetime on here. Year-to-date total return. Let's look at that just as an example. So with the year-to-date total return, as you can see, QQQ, which is the underlying ETF, is up 28%, whereas the triple leveraged ETF is only up 41.47%. This is important to understand because I think just without doing any math, we can understand that, 42% divided by 28% is not 3, right? So what this tells us is that long term, just because something is leveraged and matches daily that leverage average does not mean that it is going to long term. There are situations where a leveraged ETF, even though the underlying one goes up over time, will actually lose, will actually not gain as much. And a good example of this, I believe, is, I'm going off memory here, is SPXL, which is a 3X S&P 500, and SPY, which is a 1X, so non-leveraged. And so here's an example. We can see the 3X has gone up about 3 times on the daily average. When we look at the year-to-date total return, our 3X leveraged fund has lost 28% in the last year, whereas our 1X has, granted, only gained 3.5%, but I would much rather take that 3.5% over that negative 28%. I will definitely do a video on this in the future explaining the math, but just general rule, you need to look at it and make sure you understand the risks, involved. But essentially, it has to do with the way the averages are taken and has to do with the difference between geometric and arithmetic mean. And I think we will, that's a much deeper topic that we can broach another day. So leverage does not always mean good. Long-term average, the underlying ETF tends to do better, historically speaking, and I will have a link for that below, going over the math behind leveraged ETFs for anyone that's interested. Now that we're going back away from the screen, I think this is giving you guys a good idea. So, if it wasn't obvious, if the NASDAQ goes up 1% and you have a triple leveraged ETF on the NASDAQ, that triple leveraged ETF that day will go up 3%. And conversely, if the NASDAQ goes down by 1%, that triple leveraged ETF will go down by 3%. So this is good if you want to try to increase, gains short term, but definitely something to keep in mind long term as to whether or not that's a good option for you. Now, with inverse ETFs. Inverse ETFs are, they came to the equation when you think that a stock or a fund is going to go down in price. So again, it's much like shorting, but since the investment firm is carrying the margin risk, you won't lose more than you invested. That's the general idea. So what these do is these, move the opposite direction of the fund that they are tracking daily. So again, this is daily. And not always, you do need to read that, but most of them are. Some are monthly, some, they have different specified time periods, but that's why, again, you need to read the prospectus on any ETF before you buy it. So as an example, we'll show you again on the screen. And so here we go. When we're looking at, say, and I'm going to move this over because I think I realized you guys probably couldn't see some of what I was doing. There we go. Cool. So let's look at a good example. So my examples are going to be on QQQ and PSQ. So let's look at QQQ again. And this is again NASDAQ, NASDAQ index. And then we want to look at PSQ. All right. So PSQ. So basically the way this works is, as you can pretty easily see in the last day of trading, QQQ went up by 2.3%, and PSQ went down by 2.3%. This is essentially the way it's supposed to work. So the reason you would want something like this is if you think that the market is going to go down, maybe you want to hedge, maybe you instead of buying puts, this is something that you can do in order to try and gain when the market goes down. That's the general idea behind it. And as you know, let's again, when we're looking at these, we can see they're not always going to be the same. It's not always going to be completely inverse, but generally long-term trend, it will usually be the inverse when it's not leveraged. Now, it's important to understand though, when we're looking at these, that, you can make it be, you can make it a little bit more spicy with inverse leveraged ETFs. So now what we're going to look at is, instead of just this PSQ, which is a 1x, like a negative 1x leverage basically, what we can look at is SQQQ. So SQQQ is a triple leveraged inverse ETF. So this means that just like TQQQ, it is going to go up at 3x the rate of the underlying ETF. However, the difference is that it's going in the opposite direction. This is really good when the market or the underlying stock that you're following is going to drop, because if it drops, say, 3% in a day, which the market doesn't drop or gain or drop that much in a day usually. It's going to be somewhere between 0 and 3% on most days. And if the market drops by 2% and you have PSQ, okay, maybe you gain 2%. But if the market drops by 2% and you have, SQQQ, then you're gaining 9%, which is a much bigger deal. So, that's a pretty great option. However, we have to keep in mind that if the market goes up by only 2%, then you will lose 6%. So big inherent risk that is associated with this. So you definitely want to make sure you understand what you're doing, but it can be a good tool. And I'll explain some use cases for that later on. Now, another thing I want to try and, help y'all understand is the nomenclature. So similar to what I was talking about in the last topic, where you want to make sure you understand ETFs. Generally speaking, you can get a good idea about an ETF just from the nomenclature, especially when they are inverse or leveraged ETFs. So as an example, with TQQQ, you're looking at an ETF that, let me pull that up again. Awesome. So we're looking at TQQQ. Right. So when we're looking at this, generally speaking, the T in this scenario stands for triple. Then the Ultra Pro shares is the company, that the investment firm. Ultra Pro is what the term they use for leveraged. And then it is a triple leveraged. So this gives me a decent idea without even having to dive into the specifics of that, of that ETF. I can go and look at the holdings. You can also do this directly through the company, but here I can see, okay, well, here's the different sectors. Here's the ratings that they have on those on this investment, and then here's what the holdings are in it. We can see it has, these different NASDAQ indexes. We can see that it has Apple, Microsoft, Amazon. This is gives you a generally good idea of what's going on inside of that ETF. And then you want to look at the fund summary, and you want to see what's the goal of this ETF. And this is where you can see that, it seeks daily investment results, not long-term. It's a very important to understand, and that it corresponds to 3x the daily performance of the NASDAQ 100. Understanding that is going to help you become a much better investor and not fall for, traps of buying like a negative 3x inverse gold ETF just because you think, it looks like it's going to go up. It's not that simple when you're playing with these types of financial instruments. Now, another example that I like to show is SOXL for other nomenclature, which just means names. So this is Direxion, that's the company. Daily, that's the time period. And Direxion does a great job of, making it very simple for people. That's the time period that this is projected for. Semiconductor, that's the industry. Bull, because it's a positive leverage, i.e. it's betting long. And then 3X, because it's a 3X leveraged ETF. This is the general idea you want to have if you're just looking and this is your first, just eye test before you actually look deeper at what's going on with that ETF. And it'll definitely help you a little bit with understanding, what's going on. And then my other example that I showed previously is SPSXS, which is so again, Direxion company, daily time period, S&P 500, what it's tracking. Bear, because it's betting that it's going to be going down, i.e. it's shorting, or it is a inverse ETF, and that it is 3X because it is 3 times leveraged. So this is a general good example of what you want to be able to look at just from general eye test of an ETF. Now, when we're looking at these and we're wondering, okay, well, what's the use case, right? Why would I use these? What's the point? So the good example that I have personally is in January of this year. So to me at that time, it seemed really obvious that the market was overvalued based on the S&P 500 PE ratio. So as an example, at that time, it was about 26. And it was, historically an average normal times, it should be about 15. PE ratio, if you're not familiar, check out my video on it. But basically, where I go much deeper, but basically it's a ratio of the price of the share of stock versus the earnings of the company that stock is a part of. So generally speaking, you don't want to be overpaying for earnings that are too low. That's what this tries to mitigate. Because it wasn't within 15, because it was near double that it needed to be by the end of February and was on its way up during January, and it seemed very tied to the 2017 tax cuts, it seemed to me that there was a lot of over speculation going on, and this kind of confirmed my view that, you could see that companies were generally using the money that they saved in tax cuts to buy their own stock, which artificially inflated those prices and therefore increased the price to earnings ratio on the S&P 500 index. Then when you consider that, and so, in that scenario, I consider reality is going to set in at some point. Then when you consider that at the time, this is again January, there was obviously a pretty big medical issue going on in China and Asia that most of the people in the United States were ignoring. It seemed really obvious to me that, especially coming from a systems engineer background where I have, did a lot of work on understanding supply chains globally, is pretty obvious that there was no way this wasn't going to hurt the U.S. economy. Whether it ended up directly affecting U.S. citizens, you knew it had to affect the companies that had supply chains in those regions. And particularly, I thought that this was going to affect semiconductor companies because of the fact that Apple is very heavily involved in, their production is very heavy in China. They rely a lot on those semiconductors, and those neighboring countries rely a lot on other Chinese companies. So I decided to, essentially, I didn't want to short, but I decided that I wanted to buy some inverse ETFs against these market sectors. So what I did was I bought shares of SOXS, which is the triple inverse ETF on semiconductors. I bought SQQQ because that's the triple inverse leveraged ETF on the NASDAQ, so the tech companies. And then on the SPXS, which is the triple leveraged inverse ETF on the S&P 500. And I did this in late January and sold them as the market fell in late February in the first week of March. So, as a reality of COVID set in the United States. And now I could have made far more if I had held this longer, but that's where the risk mitigation comes in. It seemed obvious that stocks needed to fall. Once they fell a reasonable amount, I realized, okay, I've made what I need to make, and I don't need to wait for more and more cream. At the end of the day, you need to assess your risk and know when you're going to get out. And that way I was able to take that money out and then buy more stocks long as they continued to fall each time there was a red day. And that way I was able to, at least somewhat gain during the, downturn and during the turn back up. And that way I was benefiting on both ends. And that's a good use case example where I would use these. The other one would be when I was buying stocks during that time in the fall. Then I would occasionally buy some small amount of a triple leveraged inverse ETF against the S&P 500 because that was a little bit of a hedge of, okay, well, if the market falls, then it goes up a little bit, even though I'm putting a small percentage of what I'm actually investing in that. The amount that I gain, if it drops 7% a day like it did, then I gain 21%, and then I can take that 21% and reallocate it into long-term investments that I want that are undervalued at that time. So that's my general take on inverse and leveraged ETFs, and that is the end of this topic. Now let's check the chat and see what's been going on. Feed me up. Yes, I agree. Someone actually pointed that out in the comment section on one of my other videos is the cheeky pistachios in the background. And my girlfriend is Persian, so there's always pistachios around. So yeah, that's the deal. They're a very good work snack to have. Okay, and in just a moment, we will get on the next topic. This is a long one, dude. Yeah, someone did. I believe it was Premium Positivity is the name of his channel, if anyone's interested. So yeah, he has good stuff. All right, let's get to this next topic setup. Awesome. Okay, check this chat one more time, and we're good to go. Okay, cool. So the next topic I want to go over is the stock market and gambling, and basically talk about like what's the difference and whether or not there is a difference also. So first of all, I'm going to spoil it for you. The stock market is gambling. You place bets, through buying stocks long, shorting them, or purchasing options contracts. We consider gambling a vice, but not investing. And I think this is something that anyone that's investing needs to think about and understand, because investing can become gambling very easily. Now, why do we look at, gambling and investing in two different lights? Well, because we've all heard the phrase, I think, that, the house always wins when it comes to casinos and when it comes to gambling. And of course, this is referencing that, how casino games always have odds so that the casino will win more on average, meaning that you lose more, given a long enough timeline. So regardless of whatever short periods where you may win, given a long enough time frame, the expected value is that the casino is going to win more times than the, person playing the game. And, it's contrastly common knowledge that the stock market goes up over time and therefore is a fairly safe bet long-term investment. This is the perspective that most people have. Now, the issue with this mindset is that we have to remember that all investments come with risk and that there are no sure things, right? We accept that casino games are all about probabilities, and we, with the exception of games like blackjack, we have no tangible actions, generally speaking, to change them. Like, the odds are the odds. At the end of the day, there's very little that we can do about them. Whereas with stocks, we can very easily get overconfident and fall prey to the Dunning-Kruger effect. So if you're not familiar, essentially this is a term that's used to describe someone who doesn't know enough about a subject but has a lot of confidence, i.e. they have, a low level of ability, but they really overestimate that ability. This is something that's really easy to do in stocks. This is why in my opinion, you see so many people that are selling courses on like day trading and, statistically unsuccessful, ventures when it comes to investing. And this is not just with investing. Dunning-Kruger, it's very common in our society. But, as more information is readily available on the internet, we're going to have people that think they're experts on things that they don't know deeply enough. And that can hurt you as an investor. So you got to make sure you keep yourself in check. And this seems to, be even more increasingly common with more democratized investing platforms, like Robinhood, Webull. Links for both in the description if you're interested in signing up for those and don't have them. And, you'll see young they're disrupting the market because they have lower costs, no commission fees. And that's getting a lot of people that are, normies involved in something. And we need to make sure that they have a full understanding of what it is they're getting involved in, because this is not, something to trifle with. This is serious long-term implications. And young investors, it seems, are very quick to get impatient with index funds, just like all of us. This is not just a young thing. This is the access that we have makes it more pronounced. But people will generally get pretty impatient when it comes to index funds with, just a steady 8% annual growth, and what they'll do is they tend to jump to things like options, day trading, penny stocks, because they see, there's free real estate. And this is a really important thing because, when we play a game of blackjack, right, we may bet, $20, right? And we just recognize that, okay, it's lost money, right? We don't really need to worry about it, but it was fun, whatever. It's $20. Who cares? Whereas with stocks, this can easily turn into losing thousands, just because you're breaking the basic rules of investing. And that's something we need to keep in mind. So I want to go over some rules that I have for, just general rules of thumb. Again, I'm not a financial advisor. I'm a guy who is really passionate about finance and, wants people to better understand it. So keep that in mind and take this with a grain of salt. But here are some just general rules that I have for, avoiding stock gambling. Number one is first and foremost, like always, no matter whether it's any type, no matter what the investment is, if you don't understand it, don't invest in it, right? So if you can't explain what the ETF company commodity is or does, you should not be investing in it. And I mean, explain it simply to a person that has never understood, like that has never, heard of it before. If you can't do that, you do not understand it. If you don't know what the financials are, right? If you don't know what the price to earnings ratio is, if you don't know what the book value, ratio is, if you don't know what the dividend percent payout ratio, if you're a dividend investor is, you should not be investing in that stock. You do not understand it. And this is most likely going to cause you to, pull the trigger when you don't need to, pull out of a stock and lose money. It's not, or make riskier investments. This is not a good strategy long-term. And if you haven't done a lot of investing, and this is my opinion, but if you haven't done a lot of investing in stocks, long or short, you probably should not be trading options, because it's just too risky, in my opinion, for most people. Once you've been investing for a couple years, then maybe you have the, knowledge and the cojones, essentially, to do what you need to when you need to. Hold when when it looks bad and buy when it looks, worse. But yeah, in general, you need to make sure you fully understand it. And also, if you don't understand shorting, then you probably don't understand options. It's much more complicated, in my opinion. And then with that, number 2 is remove emotion, right? Hype is not a reason to buy a stock. I don't care, if you love the CEO. I don't care if you know the people. I don't care what the reason is. If it doesn't, if the fundamentals aren't there, you should not be buying a stock. And with fundamentals, that means you need to understand the valuation and you need to focus on those numbers. You need to understand what that company is worth. You need to understand what you think is a reasonable price for that company and what the long-term, value of that company could be. You need to avoid the gambler's fallacy, which, because over a long enough timeline, all things approach the expected value. The gambler's fallacy is also called the Monte Carlo fallacy. And essentially what this is where, say you are betting on the flipping of a coin, right? We can agree that if it's a fair weighted coin, then that means each time that you flip the coin, there is a 50% chance of heads and a 50% chance of tails. If we agree that it is a 50% expected value of that coin flipping either of those, then let's say the coin is flipped twice and it lands on heads both times. The gambler's fallacy would be where you say that there is an increased likelihood that it is going to land on either heads or tails because there is no change. The underlying probability is still the same. The previous examples do not change what the theoretical probability of an outcome, of a fair outcome is. Something to keep in mind. And the reason I say this is because this is the situation that we see where, people see, oh, a stock went down. Oh, it has to go up, so I must buy it. And then it doesn't. And then they keep doing this and not paying attention to the fundamentals. This is gambler's fallacy. And it also works in the inverse direction. And then for the removing emotion, you need to remember that short-term moves don't matter. Again, long-term, the stock market goes up. If you're betting on short-term moves, you're gambling, generally speaking. Nobody can accurately predict short-term moves in the market. We have to make sure that we remember that and that we're long-term investing for the average person. Rule number 3, avoid margin. Don't do it. Generally speaking, investing in stocks with debt is a horrible idea. For most people. Some people can do it. Some people really like margin, but most of the people that I've heard talk about margin tend to work for the investment firms, and they're trying to get people to, pay for their services. So it's not my thing. And even Kevin from Shark Tank on Graham Stephan's channel the other day was saying that, yeah, you should never use margin. It's a terrible idea. It hurts more people than it helps. So keep that in mind. And then 4, if you wouldn't hold it, this is from Warren Buffett, if you wouldn't hold it for 10 years, you shouldn't hold it for 10 minutes. It's a rule of thumb. If you're buying a stock and you're nervous about holding that stock for, a day, a week, a month, whatever, you shouldn't buy it. I mean, generally speaking, you should be buying stocks that you think are going to be around for 10 years or more. And if not, then you're adding more stress to your life than you probably need for 98% of people. 5 is there is no such thing as an easy or guaranteed amount of money, right? If something seems too good to be true, it is. If someone is selling a course on day trading, then I'm just saying they probably aren't making much day trading. There's a reason they're looking for that other, income stream. And pretty often this seems to be the case. A good example, if you want some entertaining looks at this, is CoffeeZilla. He does a great job of pointing these out. And then anytime you hear about something that's that's promising over 10% annually, pretty much, if it's guaranteeing that, it's a scam. Like it just is. That's not there's the S&P 500 index is the best for the average person at 8% per year. If someone's, and that carries risk. If someone's guaranteeing you that or more, it's probably not real. You need to be skeptical of that and understand what is an expected outcome when you invest. Number 6, be consistent. If you lose money, do not revenge trade. This is the part of the gambler's fallacy. If you lost, you lost. The odds don't change because you're upset. It doesn't matter, right? And avoid making exceptions to how you evaluate an investment, i.e., My rules, as an example, are I only buy stocks on red. I don't care how good of a deal a stock is. If it's on green that day, I don't buy it. This is not because it's not necessarily a good deal if it's under my, valuation for it, but it builds a good mental habit where I don't end up chasing stuff. And then I also only buy stuff with low P's as a general rule. I will sometimes buy something that isn't, but as an example, this is why I wouldn't be buying Amazon right now, because the P is too high. I don't care how good the company is. It's overvalued in my opinion currently. Rule number 7, be humble. The stock market is a competitive environment with, algorithms and millions of people who have more money, more knowledge, and teams of people, right, that are working to compete against you. Thinking that you know more than these people is generally a pretty big mistake, okay? Well, you got to keep in mind that the stock market is essentially like an open basketball court, but LeBron and Kobe and anyone that, is able to walk up. If you think that, if you like your odds in that scenario, then that's basically what you're doing. You're not going to be able, if you think you have the scoop on something because you read about it on Reddit or wherever, you might want to think about that one again. That's you're dangerously close to Dunning-Kruger. So that being said, every now and then you can find some good, info, but fundamentals is what I prefer. And then rule number 8, my last one for this, is valuation is what matters, not price. And this is a take on the Buffett quote of price is what you pay, value is what you get. If you think a company is worth a certain value, then if it's under that amount within your margin of error, then you should be buying it. If that price goes down and you're holding, in my view, is you buy more of it. You don't sell it because as long as you agree that it has not changed fundamentally what its value is, you should be buying if it's undervalued. It's the same as when you go and buy stuff on sale at a store. If it's under the price that it's worth, I'm going to buy it. I'm getting a sale. That's the way that I generally want to think about stock market and gambling, and make sure that we avoid these pitfalls as, retail investors especially. Okay, now I'm going to come back to the live chat before getting on to my last topic of the day, which is going to be on portfolio management and so this is going to be for like planning for retirement. What's the 3-fund portfolio, things like that, and going over that in very, very good detail. Okay, looks good. I'm going to get started in a minute. And again, if anyone is new here, I am about to start on the last topic, which is on portfolio management for retirement and on the 3-fund portfolio. And if you have any questions or comments, put those in the chat. I will get to them at the end of each topic. And that way I can stay on point. And thank you for your patience. It's actually not pre-workout. I am a child. This is grape Hawaiian punch because, I have to reward myself when I do these long streams. I had too much caffeine beforehand, sadly, so I can't do pre-workout right now. Okay, and the last topic for today is on portfolio management for retirement and what is the 3-fund portfolio. So why does this matter? Well, most people don't have the time or energy to focus on managing their investments. And portfolio management is essentially managing risk and expectations of investments. So when we're trying to manage, our own portfolio, or we're trying to figure out who should manage our portfolio or how, the different things that you want to keep in mind are to know your risk and your time horizon and your age, which is inherent in your time horizon. And you want to create a portfolio based on those things. So as a general rule, just to keep you emotionally grounded, what I think is good advice, and there'll be a link below for this from Michael Batnick, an article explaining this, who's a really good resource and fund manager in Wall Street. And you want to prepare for the worst case scenario. And that's kind of what you shouldn't, you should not have more in stocks than you're willing to lose. So as an example, he points out that, looking back at the financial crisis, stocks could drop 60%, right? Like they did during the financial crisis. So if you were to have an all stock market portfolio of say 100,000, right, in your retirement account, then that means that if you choose to go with all stocks, that you should be comfortable seeing that 100,000 drop to 40,000 and still hold it and not sell. And then when you think about this, if you wouldn't be able to stand this, then you probably need to diversify, because you're not going to be able to hold when it matters, which is in a bear market. And that's when people tend to make mistakes. People don't usually make horrible mistakes during bull markets. They tend to make really bad mistakes and do irreversible damage by selling when things have gone down, which is the opposite of what you want to do. You want to buy things when they're on sale, assuming that you have, an emergency fund and things like that in place to keep you from, having to need those long-term investments, which is always the priority. So this need for diversification, of course, brings up the question of, what is diversification? And just as a general rule, it's reducing risk within a portfolio by not relying too heavily on one asset class. So in the example that Batnick points out, that generally speaking, you have stocks, U.S. stocks, and then you want to maybe offset that with some percentage of bonds or international stocks. And then the question is, of course, how do we decide the breakdown? Well, one proposal is a 3-fund portfolio for people that want really simple stuff. And a 3-fund portfolio is a mix of U.S. stocks, international stocks, and bonds. So, U.S. stocks, the general rule is for stocks overall to take your age, right? Subtract that from 110. So as an example, if you are, say, 30, your age, 110 minus 30, right? Then you're looking at, that whatever's left, you're looking at that percentage. And that's the general, way you're going to decide stocks. So as an example, with me, I'm 27, right? So 110 minus 27, that's 83. So I want to generally have 83% of, and this is a rule of thumb, I generally want to have 83% of my portfolio in stocks. This is about what I have. I might have a little bit higher than that because I'm being a little bit more aggressive, but that's the general rule. And then what you would do is you would say, let's say it's even easier. Let's say you're 30, like I was initially stating. And that means that, of course, you subtract from 110, you have 80% in stocks. Then, generally speaking, that means you would normally put the other 20% in bonds. And then what you would do is you would cut that 80% into U.S. and international stocks. When you're looking at U.S. stocks, you want to remember that historically, that the S&P index, like the S&P 500 index funds, are going to have the best returns. And you want to generally pick those with the lowest fees. So as an example, what I do is I pick FXAIX, which is through Fidelity, because that's who I have my retirement plan with my employer with. The alternative is Vanguard, which is VFINX. These are just 2 examples. But the Fidelity one has a lower fee, so that's the one that I go with. There are also ETF versions of this, which are VOO and VTI, which have equal expense ratios. However, VOO tends to outperform VTI, so that's something to keep in mind long term. But the point is, you have access regardless of whether you have it through a retirement account or through Robinhood or Webull. Now, for international stocks, the reason you would want these is these are basically good for lowering the risk associated with a single, company or country rather, having economic instability. And they generally, at least historically, have not performed as well as the S&P. So most people prefer to have this as a smaller portion of their stock holdings. So for example, someone who, who is 30 has 80% in stocks. Let's say they put, 50%, right, in the S&P. So 50 of that 80% in the S&P. Then maybe they would put 30%, the other 30% in international stocks. Good examples for these funds are through Fidelity, which is FSPSX, which is the one I use. And then Vanguard is VTIAX. Fidelity has 1/3 the fees of the Vanguard fund, so that's the one that I use. And then the ETF that is, generally the one I look for is VXUS. So again, there are these options regardless of the brokerage or your experience as an investor. The third part of the three fund portfolio is bonds. So bonds are historically the best hedge against stocks. And the reason is because they tend to do well when stocks do poorly, and they have generally a minimum downside. So they tend to not drop as much as the basic premise. Now, people who want like the simplest portfolio generally will just get a 2-fund portfolio, and that'll be stocks and bonds. So if you're 30, you 80% stocks, 20% bonds, done. Move on with life. However, bond yields are historically low right now. They were much higher in the 70s and 80s and 90s, but they're very low now. So personally, I don't see that this is an optimal strategy for younger investors. So what I personally do is I only keep about 10% of my retirement account, not my total savings, in bonds. And I use VBTIX, which is the lowest expense ratio that I've seen. VBTLX is also an option, and the ETF for this is BND. So for my personal choice in my retirement account is I put like 70% in S&P 500, 20% in international stocks, and then the other 10% in bonds. So as you can see, I'm a little high in stocks, but that's because I have a good amount of an emergency fund sitting around, and so my risk tolerance is a little bit higher. Also, I had a higher allocation towards bonds before COVID, but I changed the allocations due to the drop because you saw a lot of drops in, international and U.S. stocks. The bonds hadn't dropped as much, and either way, I wasn't selling them. I was just reallocating the contributions that I was making. So I just started contributing more towards stocks because stocks have been undervalued, relatively speaking, over the last several months. And I may need to reallocate that now that things are, generally on an upswing. Now, for you, if you're trying to figure out what to do, you're new to trying to figure out your retirement account, how you're going to set it up, there are several options where you can encompass all of this. The first one and the easiest is a target date fund. So if you're at a company, generally speaking, they offer you different funds. One of them would just be, say, like 2060 retirement fund. So this would be an account where they have several investment vehicles underneath it. It's passively managed, and based on your age, they just adjust the allocations between stocks, bonds, whatever. You have to read the specific prospectus of it, but that's the general idea. These will always, at least in my experience, have higher fees, so I don't do it because I can pick funds. It's not that hard. You just pick 3 with the lowest fees. And so, but that is an option for people that want no frills, and it's better than not investing. So worst case, tell people to do that if they're asking. The second option, which is what I go for, is finding the lowest fee of each and choosing those. And then I reevaluate with a financial advisor annually. And this is not something that you need to worry about going out and trying to find. If you have a account through Fidelity or one of the traditional brokerages, then you should be able to do this every year, at least on the phone, if not in person. And I think that's enough. And it's a short, easy call. It's just what are your goals? What is your age? And, what type of allocations they think you should have. And then they'll give you some advice. And I think that's, you should take advantage of it because it's free. And it could save you a lot of money in the long term. And then the third option are robo-advisors. So robo-advisors they're like target date funds, but different in that they're doing these choices for you. And you basically go on, you answer some questions about what your risk tolerance is and what your age is and what your retirement goal is. And they pick Vanguard funds based on your goals. And then they charge you a little bit more of a fee, but it could be something that's really good for the average person because there are thoughts that they could outperform target date funds in the short term at least. Good examples of this are Wealthfront and M1 Finance. I have a link below for Wealthfront if you're interested in checking that out because it gives you some type of kickback, and might as well if you're going to be interested in that. And at least putting a little bit of money in that if you're someone who's just getting started and doesn't want the stress of worrying about it and wants to learn in the meantime, it's not a bad way to start off. It's better than not investing. So the takeaways of this are don't waste money on fees. Get the lowest fee, for the same investment that you're going, if it's the same investment allocation, get the lowest fee. Don't pay more. Meet with a financial advisor annually. Be humble. Don't think you know everything. I meet with them and I'm talking about this stuff, at length. So we can always learn. If you have a Roth account available, so as an example, traditional accounts, 401k and IRA, so traditional retirement accounts, they are not as tax advantaged as Roth accounts. They are tax advantaged on the front end, meaning that if you are, when you're putting the money in to the account, you're not paying taxes on it, which means that you have a larger amount of money that is growing over time. However, you pay taxes when you pull them out in retirement. With Roth, when you put them in, they are post-tax, which means that you don't have to pay taxes on them when you pull them out. This is really good because it helps you a lot, especially as a young person, because when your taxes are lower, you will pay less in theory. And then when you pull them out later on, all that money you're pulling out is tax-free. So if you have the access to a Roth account, which everyone has the access, they can make a Roth IRA, which everyone should, if they are below the income cap, which most people are going to be. I believe it's $120,000 per year. And that's taxable income. So if you already are lowering your taxable income by contributing to a Roth IRA, then, say you have $138,000 salary. If you're contributing $18,000 plus to your 401k, then you're still below the $120,000 limit and you can still max out a Roth IRA, and you should if you can. I have access to a Roth 401k through my employer, and this is definitely something anyone should check out. I'll do a breakdown on the differences between Roth 401ks and Roth IRAs and traditional of each in the future. And then lastly, keep in mind that risk tolerance matters. Okay, I go heavier in stocks because I have at least a 6-month emergency fund, and within other non-tax advantaged investment accounts, like Robinhood, Webull, accounts that I don't have to wait until retirement to pull out without a penalty. I have over 2 years of expenses saved. So I'm able to be a little bit more risk seeking when it comes to my retirement account because I have a really good backstop if, everything goes to crap. So keep that in mind and assess your risk tolerance. And check out that article by Michael Batnick if you want to have a better idea of how to do so. And that's the end of this topic. And now I'm going to go back to the live chat and answer the last questions before hopping off here, guys. And yeah, if you have any questions, put those in. And if not, I will be hopping off shortly. Awesome. Okay. Looks like there are no further questions or comments. Thank you guys so much for watching the Wealth for 99 podcast. I really appreciate it. Be sure to share this with anyone that you think may be interested. We're, again, trying to spread ideas and understanding of different financial, economic topics for the working class and the average American. And let's make sure that, we try and build, worker consciousness and understand that everyone, that we need to work for what is best for us and make sure that we're, we have good financial futures. And also throughout the week, you'll notice that I will be clipping up this podcast to have separate videos for each of the questions. So if people don't want to sit down for, 2 hours and listen to me talk, then like you wonderful people have, then they can see those in shorter clips, and that way it's even easier to share it with people. So thank you guys so much for watching. I'll be back next week and watch for video uploads throughout the week. Really appreciate you guys here, and you guys have a great day.